Let's get some more on all of that and what to expect from the local share market this morning. We're joined by Evan Lucas from IG in Melbourne. Evan, great to see you as always. Yeah, just firstly on the strength that we're seeing in the Aussie dollar this morning and the move above 91 US cents. It's just below that right now. But what do you make of this move? What's behind it?
Yeah, I think you're actually seeing a little bit of dissipation in the US dollar strength we saw probably Wednesday night, Thursday morning, etc., when the whole sort of Janet Yellen sort of used that quantification word of what's, a considerable amount of time was. That's part of it. I think also, again, it gets back down to the central bank differentiations that we're seeing. So we are now looking more likely to see the RBA moving on rates to the upside rather than on the downside. A lot of economists are shifting that as well. I also think that you're starting to see a real decoupling of the Aussie dollar away from being a commodity-driven sort of currency towards a more domestic demand idea. We are seeing housing still doing quite well, even though we've sort of seen a bit of a subdued 2 or 3 months. We also are starting to see better than expected non-mining sector material. It's not overly strong, but it's green shooting, and I think that's also why you're seeing that. And that would mean that on a medium to longer term basis, the likelihood of seeing the Aussie dollar above 90 cents is getting stronger and stronger, because I also think the US dollar strength we saw last week will again be sort of questioned as Janet Yellen starts to talk about no interest rates probably aren't going to move until midway through next year, and that will be US dollar weakness. QE is now being factored in, and I think you're also seeing that as well. So it is an interesting perspective, because again we keep hearing from the RBA that it is historically high, and we know that the economy needed it to be lower. If you look at the first half earnings season that we just saw, all of the mining and energy plays talked about the fact that the Aussie dollar was lower for parts of the reasons why they had such a good report. So it's a catch-22. We probably don't need to see the Aussie dollar higher, considering the market is trying to find reasons to go up, and that is at the moment probably being a bit of a dampener on where we see it. So the Aussie dollar likely to be affected by the HSBC numbers today, but again looks like it's going to hold above 90 cents, and it will probably push into 91.5, even as high as 92 over the next 2 or 3 weeks.
Right, okay. Yeah, and just on that HSBC data you mentioned there, that flash manufacturing data for China, out 12:45 Eastern Daylight Savings Time, a slight lift expected by the market. I mean, what are the possible reactions though? I mean, what are you expecting?
Yeah, so there is a possible slight lift, and so the current consensus number is 48.7. So that is still contraction. Would mean that in 2014 we have not seen SMEs over in China actually registering an expansion. So we haven't seen, the last figure we saw was 50.5 for December. Ever since then we've been in contraction. There is a real possibility here that this could have upside surprise, and the reason for it, the back end of February we did see a little bit of increase in steel demand. We saw a slight increase also in industrial production, although it was weaker than expected. It was a little bit better than the month before, so there are chances you may see a better than expected number. But in saying that, there is a lot of talk about collateral at the moment, and the fact that collateral has been used on a lot of stockpiling of copper, also iron ore, gold, etc. And that could see that we did see dumping, and that may mean that we're actually seeing a bit of a back end. But as I said, I still think there is the possibility of upside. So you may see an initial read of contraction that may see the Aussie dollar coming off ever so slightly, but I think looking at what you're seeing, the data does look like it could be a little bit on the upside, and therefore pop up on the Aussie after the fact, and therefore commodity plays may actually get a little bit of strength from it, because the flash data tends to be a little bit overreactive to what the actual final figure comes out. So that's my expectations. A fairly, a better than expected read, might be still in contraction, but it will probably be an upside surprise likelihood rather than a downside surprise.
Okay. And just looking at the ASX 200, what's your sense of how it will open? What's your opening call?
Yeah, having a look at it, it does look like we're going to push backwards, unfortunately. So we're looking at around about between 25 and 30 point contraction. So that means around about 5,300 point level, maybe 5,310. That again is that resistance level that we keep testing. It is also the last week of March, and then it's also the last week of the month and the quarter is unfortunately in the red. So you may also see fund managers starting to position themselves for the end of the week and starting to position into that end of the month and into the quarter. We are down therefore year to date by roughly around about 50 points. So that also may be what you see throughout the week as well, as that positioning happens rather than any sort of major moves, and it will make trading look a little bit disjointed and a little bit, a bit questionable probably is the word. So be aware that may also be a reason for it. There isn't a huge amount of data that's actually overly effective till next week when we see the start of April, so end of March data to come through. So that's all what's probably going to market the market this week, and it is going to be a bit of a sort of a volatile week in terms of what happens, and therefore choppy trade as well.
Evan, thank you so much.
Thanks, Brady.